All right. Hey, welcome back to How to Invest in Commercial Real Estate. Today is a super exciting episode because we are reviewing our latest offering or our latest property acquisition. A super exciting deal out of Wichita that we've been working on for a few months now, and we have closed on it by now. We closed on it on January 12th, and we're super excited to have it in the portfolio. And one of the biggest questions we're always getting is, how you found the deal, what you like about the deal, future plans for the deal. You own it. What now? How long are you going to hold it? What do distributions look like? So today we're going to take a deep dive into Plaza West and why we love it.
Yeah, good intro. We do get a lot of those questions because that's the main thing people want to know is, tell me how to find the deals. Tell me how to evaluate the deals. What'd you like about that deal so I can feel comfortable pursuing my own deal? So let's start in. This one was a random email on a list that I was on. We've encouraged you guys before to get on brokers' lists.
Mm-hmm. Yeah, we said that a ton.
Just finding who's listing deals and getting these guys are out of the West Coast. They really don't have an affiliation with Wichita.
Doesn't make sense.
But I saw it come across my desk, and I think it was the ask cap was like 7 3/4.
7 3/4.
And so for me, okay, there's some potential there because we like to be at 8.5. Where debt is today kind of gets us where we need to be on cash. And the price per foot was pretty low. So I gave it a call.
Yeah, like $62 a square foot or something, or just north of that.
Yeah, and I mean, for Wichita today, if you were to try to replace that, it'd probably be 3 times that. It'd probably be $180 a foot to replace this, or two and a half at least. So that was attractive right off the bat. But I mean, the fact that it was a Southern California, I think it's California listing broker. They didn't really know much about it. They weren't. I mean, you talked to the broker.
I asked them a bunch of questions. Hey, what's the going rents? What's the average? Price per foot for the rent, and what's the current occupancy in the area? And really, they didn't know a bunch of stuff. But for me, if you find a deal at $60 a foot, where retail is going anywhere from $100 to $250 a foot, let's say, for me, there's opportunity there. It's either in a really bad area, and you're going to know when you get there,
yep,
or there's something else that's going on there that's allowing it to be pretty low per foot, and there could be an opportunity there. So that's why we kind of initially pursued it.
Yeah, and we look at so many deals. It's hard to act on every single one of them. But I remember this was a specific time where we needed a deal, and we were looking at a ton, and we came across a list of like a dozen. And I kind of mentally decided, one of these needs to work. And we looked through the dozen or so OMs, all kind of resonated with this one. It was super cheap per foot. The rent roll was a really great mix. You actually got the pads in front of the shopping center, which is kind of rare. You could probably flip those off. But anyway, we drove down to Wichita, a week later?
Yeah, I think we had put an LOI in, so I had no idea if we were going to get it, but just kind of in the range of where we wanted to be, drove in town, and it wasn't a bad corner at all. For $60 a foot, I was expecting way less, and the traffic counts were great. It was about 20,000 per street, so combined 40,000 at the intersection, which that's good.
Yeah.
And then there was a decent grocery store opposite corner, a couple of restaurants, some nice out parcels, Walgreens. So I really felt like, okay, this should be even a discounted retail. Like we purchased in a little bit lower income workforce housing areas, and we paid $100 a foot. So we're still at $60 a foot here. I don't know if we're going to bring it up and let people see. Part of the center had been renovated. If you can see the picture there, the layout, the Dollar Tree there in the corner, and that section had kind of been refaced, and it looked really nice. So it gave us some options that maybe we could do that with the rest of the center. Instantly, you can see that very rarely do you see these older shopping centers where they own the out parcels. And so here we own 3 out parcels that come along with this center. And so if we're buying at 8.5 cap, could we spend the out parcels at a 6.5, 7, and really get a good return on those?
Yeah, and then another thing is we found out this Church's Chicken pad, if you want to pull up the site plan again, that Church's Chicken pad had just sold before we got it in contract. So that showed me, new development in the area. Somebody's willing to come in here and buy a piece of land and build a Church's Chicken. That's obviously a good enough area for brand new construction. They're going to be at a way higher basis than the tenants that are already there. So that was promising.
For sure. You don't often see national chains putting brand new stores in bad locations.
Yeah, right.
They're just smarter than that. They have a lot of metrics they use. And so that was a great sign. I'd rather have owned the pad, but it was still a good sign to us that brand new construction was going right in front of the center.
Yeah. Some other things we liked. Well, the demographics were really good. I think the 1, 3, and 5 mile counts were 20,000 homes within a mile. I think it was like 75,000 within 3 miles and 200,000 within 5 miles.
Yeah.
Also, when we got up there, it was like a Tuesday morning, and it was really crowded. And as we walked it, and it started to get lunchtime, lots of people were coming in. So, and there used to be a neighborhood market, and so Walmart, they're not dumb when it comes to demographics, and they felt like it was worth their time to put something in there, and then ended up building something else down the road and pulled that neighborhood market. But
it's not the demographics. When you say they're really good, I think they're good for the style of center that we have.
Yeah, right.
They're not an average household income of 120,000.
Right. I think
they're maybe 60,000.
Yeah, right. 60,
but that's actually okay. It's good a little bit above workforce housing, and for the tenants that we have, and for the rents that we're charging. So the next big thing is when we started looking at it is now we have a low price per foot, we have a decent cap, but some of these rents are ridiculously low.
Yeah.
And we're talking $2-3 a foot, some of them.
Yeah.
A year.
Yeah.
Yeah.
And to me, that's crazy. And for those that are listening, when I go to evaluate a deal, we have some retail that's in $25-$30 a foot a year, okay, and businesses are making it.
Yep.
And you have some other areas that are a little tougher, and they may be at $15 a foot. But what I know about retail from all of our experience is if a business is viable in a spot, they can afford $8-10 a foot minimum. Mm-hmm. Unless it's the 40,000 square foot space, but if it's 2, 3, 4, 5,000 square foot, they can $8 to $10 they can afford. So for here, what we had was an owner that had owned this for a long time, had some vacancy through COVID, and they had bent over backwards to get tenants in there, putting them in at $2, $3, $4 a foot.
Yeah. Probably with little to no TI at that.
Yeah, and their goal was probably to flip it, which we see that they got it filled up with what I call really low rents, and then they put it on the market and try to maximize the value. Well, for us, the good news is if those tenants make it, if they have a successful business, then not only can we get 3% increase, 5% increase, we may get 50% increase in rent, 100% increase in rent.
Yeah.
Go from $3 to $6 over a 5-year term. And that is where you really can juice the returns. And so that was really what we got excited about. Yes, there's risk because there's some bigger spaces, but you're not having to replace any rent. The bigger spaces have super low rent, so it doesn't just totally impact your cash flow. But if you do get a business that works, you can really maximize the return.
And if for some reason a couple of the tenants don't work out, the rent's so low, we should be able to backfill pretty easily.
Yeah, and that's the thing. I mean, when you're talking about a 7,000 or 8,000 square foot space and that going vacant, that could hurt. That could be a lot of money. But at $2 a foot, it's like $15,000 a year you're losing. And you can re-tenant that for put it on the market for $5,000,
Yeah. And it's classic, just like we did on Village South. Owner has owned it for 20 years maybe. Their basis is nothing.
Yeah.
They have just kind of been taking the cash flow, and now they're ready to move on from it. And so they're not trying to ink out every last dollar. They're not trying to, to get the highest rents. They're just trying to fill it and sell it.
Yep.
And that's a great opportunity for guys like us to come along and buy it second generation.
Yeah, so you can see here on the OM, the Dollar Tree and the Restore that anchor it are pretty nice. They resurfaced those or refacaded those, I guess. Both of those are great tenants, discount retailer. And then the rest of the tenants really play into that. This buffet city was, it's an Asian buffet, probably popular, super at lunch. But we went there at like 11, and it just seemed like people were lining up in the parking lot.
Yeah, and the exterior is a little bit tough to look at, but it's a real simple exterior, and so it can be facaded pretty easily. I mean, it's going to take CapEx dollars to do, but to resurface that like the Dollar Tree, like the Restore, it's going to turn that center into what looks like a brand new center. Yeah. And with the low rents, that'll help us increase those over time.
Yeah, and again, the demographics. I mean, the $50,000 a year household income. That's the type of demographic that's going to come in and get a little Caesar's Pizza, get their nails done, get some stuff at Sally Beauty, discount clothing store, Dollar Tree, rent a center. I mean, those are all really good co-tenants for the center.
Well, so what do we do on lending? That's the second piece. Once we get excited about the deal, we went and saw it. Everything's fallen into place.
Yeah.
So the next thing is, okay, well, how do we maximize leverage? And we ended up going with a lender out of Little Rock.
Mm-hmm. Yep.
That had done a couple of deals for us on the precision side in Memphis. And so they've got a great program where if the cash flow is strong enough, they'll do up to 85% LTV.
Yeah, and that's Reliance Bank.
They've been fantastic to work with.
Super competitive rates as well. I mean, when you're talking about 85% of the capital stack of a property like this, $7.5 million, the majority of the money is coming from debt. So, I mean, if you're saving half a point on $6.5 million, that's $30,000 a year in free cash, just right there. So finding a lender that you can partner with and is giving you competitive rates. I mean, they're obviously making a little money, but they could make more. I mean, when we're quoting a deal out like this, we're getting rates in within 60 to 70 basis points probably. I mean, we actually had that super low one, so it may have been higher. But anyway, ran the traps with the lender. Not every lender works out the first time. This particular one had some existential circumstances going on in the bank. We picked it up and kicked it back over to Reliance, and they closed it great. I mean, they were super easy to work with.
The key to remember on the lenders is you've got to have some competition to leverage. So we got 3 or 4 bids for one reason, because some lenders aren't going to like the older center for whatever reason. Mm-hmm. And then another guy will look at it, another girl will look at it, and they'll say, hey, this is great, and they'll give you the quote. And then you need at least 2 quotes to try to leverage that rate and say, okay, just being up front, we got a rate at 3.75, you're at 4.25, and really try to leverage that out to get them to kind of bid a little bit against each other.
Yeah, we had one lender that we went to here in town, and they didn't want to quote it at all, and that's okay. Like you said, it was mainly because it was an older center, but that's okay. Others will, and we found someone and got excellent terms.
Yeah, I mean, spend some time on it. When you get a deal in contract, it's really important that you're getting the most competitive mortgage you can. I mean, you owe it to your investors. If you have investors, you owe it to yourself. If it's just you, I mean, you can make a lot of money and lock in a lot of guaranteed cash flow for the future by negotiating a really good loan today. And I think we did that on Plaza West. We got a great loan.
So there were some risks, and I'm going to talk a few of those now. It has a lot of large spaces. The Restore is a big space, although they're doing well at the space, and a couple of the sections are really deep, and so you're looking at 8,000, 10,000 square feet. That's a lot for a retail center. Mm-hmm. So really, every deal is going to have risks that can put you off the deal and say, well, this is why we shouldn't buy this. So you need some other counteracting factors to convince. Yeah. Because I always tell people, you can always talk yourself out of buying every single deal that you look at. And for this one, older center, low price per foot with some bigger tenants. So then let's talk about what talked us into it or what counteracted those risks. And the first one was the out parcels. I think you did some math on the out parcels. If we're able to spin off the out parcels at a market cap rate, what does that raise us from a cash flow perspective?
$3.3 million.
Is that the total?
Yeah, you could sell the 3 pads for $3 to $3.5 million. Pretty easy.
And so then minus, if you take it at let's say we purchasing them at an 8.5 cap roughly, what is that? What is the difference between those two? Was it $1 million? Was it $1.5 million?
Yeah, I mean each different piece. I mean the Wendy's, you're going to get a different cap rate than the taco store, and you're going to get a different cap rate on the Loan Max. I mean blended, you're probably a 6.5 cap between the 3 of them, and we bought it on an 8.5 cap. So you're making 2 points on a couple $100,000 in NOI just immediately.
Okay, I think I don't have the math in front of me, but it seemed like that if we sold all those and you subtracted what we paid for them at 8.5 versus what we sold them at, it raises about $1 million or $1.25 million in profit.
Yeah, I figured you would probably pay down the debt some. So
yeah, I'm just saying in general, for us, that's over half of the equity raise. So if the deal works and we're able to sell those out parcels, even if we pay down the principal in the interim until we refi that cash out, that's a 50% plus return up front on our capital.
Yeah,
not 10% a year. We're still going to, the cash flow is still going to make the investors 10, 12, 13% a year. But if we can get an additional 50% return, that really counteracts some of those negatives that we were talking about.
Yeah. Well, and you talked about some of the risks with the bigger spaces. So we looked into those a little further, right? Didn't you, Braden, look into some of the statistics on the restore and some of the surrounding restores and this particular one as far as how well they were doing on sales? And
yeah, there's a company out there called Placer, and they use cell phone data through third-party apps on the App Store through Samsung and Apple. And without getting into too much of the intricacy of how the app works, they're basically through some sort of algorithm and AI software that they have, can track your spending habits based on how long you're at the store, where you're going. And they obviously have authorization for the location through the app. But anyway, they put together these retail data reports and can say, hey, based on the location of cell phones going to the store, they should be doing this in sales. And then you can at least get the raw location data. You can say, hey, there was 45,000 people that visited this store and on average spent 60 minutes while they were there. And then you can rank those not only throughout the city and the region and the state, but nationally. So we got that report on Restore, which is owned by a nonprofit, Habitat for Humanity. And the data suggests it's the top one in the state out of 4, and it's in the top 10% of the country out of a couple hundred.
And it's a fairly new concept.
It is a new concept from them.
And you would say, well, what kind of store is it? If I had to describe it, it's kind of like a thrift store version of a Home Depot or a Lowe's.
Yeah, right. Like an Ace Hardware or something.
Yeah, where people can go and get discounted building and construction supplies.
Yeah, William Furniture.
Yeah, and I live in a pretty affluent area of Jenks, Oklahoma, in South Tulsa, and they put one like a mile and a half from both of our houses.
Yeah, right.
And so it's a concept that can work in a bunch of different markets. So we felt pretty good about that concept.
Yeah.
Yeah, and just looking at the center, we did our site visit, and everything seemed in relatively tight condition. There wasn't a bunch of trash everywhere. Things weren't falling apart. The parking lot was
decent.
To hell. I mean, it was crack filled. It looked like it was recently sealed.
The property condition report came back pretty well too.
Pretty
good, right?
Relatively recently replaced roofs. Had some wear and tear, some ponding. Nobody ever plumbs the condensation lines in the HVAC units out to the back of the roof. They just plumb it to where it puddles underneath it. So I mean, it's just a bunch of little things you can do. But that really comes from the seller profile. When you're going up front in the beginning of the deal and asking the broker about the seller profile, which you should if you're not doing that, these are the kind of things you can learn. How long has the seller owned it? What's the motivation for the seller selling? These questions can give you some insight into what you may be looking at a property. If somebody's owned a property 10 or 15 years, I'm telling you, they don't care, and they're not caring about plumbing the condensation lines of the HVAC units. They just don't care about that.
I mean, yeah, think about this scenario. Someone just purchased this property 3 years ago, and they have had to fill units at $2 rents, vacancies at $2 or $3 or $4 rents, and they're struggling to make their mortgage payment and they need out. That's a whole different set of problems than someone that purchased it 20 years ago. Their cost basis is nothing. They're making money whether they fill the vacants or not. The vacants is just gravy. They're getting ready to sell it, and they want to maximize income, so they throw tenants at whatever it takes to quickly get them leased. And so there's less risk on those low rents than there was in that previous scenario. Well, so let's talk about, we talked about how we found the deal. We evaluated the deal. We got a lender on board. We did our site visit. Everything's looking pretty good. We have some risks, but we've counteracted those risks with some upside. Now we launched. How did the equity raise go? And I don't know when people will watch this video, but we launched, I think, right before the end of the year, or right
2 days before Christmas.
Yeah, right before Christmas.
Okay, 2 days before Christmas.
Launched the 23rd. So you not only have the down payment, as far as, you're getting 85% equity loan, you just have to come with that 15% of the purchase price. No, you're going to have closing costs. You may have fees associated with getting the deal done. You're going to have inspections, all of that stuff. You're going to have operating capital. We typically have a month of operating capital. We typically overraise for capital expenditures, deferred maintenance. tenant improvement dollars, leasing commission dollars, because we want to go in and be able to act. If we get tenants, we want to have that cash. We don't want to stuck and do a capital call or have to sweep half of the cash flow to fill up a reserve account, the first year or two.
Yeah, let me mention that too, because I invested in a deal in Colorado. It was a two tenant hotel deal.
Yeah.
And COVID hit, which COVID was bad.
Especially in hospitality.
Yeah, it was bad, but they literally, we had a bunch of properties that got shut down. Okay, I didn't go capital call one of my properties. We have 20 of them. Yep. Okay, and at Precision, we got several at Criterion. I went to no investors to ask them for cash, and if they don't participate, to dilute their shares. For me, it wasn't a perfect scenario, but I had hundreds of thousands of dollars in each property's operating account for a type of situation like this.
Yeah.
Right.
Well, it wasn't. COVID kind of got serious in April with shutdowns, and it wasn't May. A month in,
Really?
They say we are out of cash.
Gosh.
And we have to do a capital call. If you don't participate, your shares are being diluted.
Wow.
So they literally walked in with no cash.
Wow.
It'd be one thing if they had occupancy on the hotels were down 4 months into COVID.
Yeah,
this was
right.
literally at the beginning. They did not prepare for anything.
Wow.
And so for us, I just want to point out is that we are bringing CapEx into the deal because you might lose a tenant.
Yep.
If you lose a tenant, what do you have to do? You're going to lose the rents. You're going to have to pay for potentially tenant improvement dollars to entice a tenant to come in. You're going to pay for leasing commission.
Yeah, you get 3% right off the top, maybe
at
6.
least 3, maybe 6.
Yeah.
And so part of what we're raising here is all of that money. We could project higher returns. If we didn't raise for all that, because the more money you raise, then you have to divide that money, the cash flow, by that money.
Right.
And so it dilutes your returns. It shows a lower return, but the deal's safer. And if you never use that cash, then you're going to beat your projections.
Yeah.
And so that's what we've done here. Got a great loan, 85% LTV, but we're still walking in with several $100,000 in cash, potentially to re-facade the exterior, but also in case we have vacancy, TI dollar leasing commission. And so I think we're pretty well set up here. But we over-raised in 7 days.
In 7 days.
Yeah.
Within
7 days.
Yeah, 2 days before Christmas. So Christmas was one of those days. New Year's is approaching rapidly. I'm out with COVID in the middle of all of this. Yep. Hey guys, can you take this call? Hey, can you take hey, so-and-so wants to talk. Can you chat with him real quick? But yeah, it was like a weekend, over one of the biggest holidays of the year. And the $1.85 million we were wanting to raise sold out.
Yeah.
And it was nice. And they didn't wire us the money that week. They go to our web here, Tanner, pull this up. Keep me logged in. So this is what it looks like. They go to our portal. They're going to get an email and they're going to say, hey, Criterion's got the latest investment opportunity for you to check out. Here's some highlights. Click this button and check it out. They're going to come here and scroll through pictures. You can see, some highlights. We've got a brochure in here you can go check out. It gives you some, the fundraising status. So that's kind of a gauge of time for some investors. Like, hey, they're already 90% full. I better get in my commitment and ask questions after.
Yeah, we show that because if you are interested, this is for future deals too. Call us. Say, hey, put me down, get me in, because we do fill up quick on these, both Precision and Criterion. We fill them up quick.
Yeah, so it just goes through rough terms. You've got to buy shares in $1,000 increments. We're raising $1.85 million. We are targeting to close on the 12th. We are asking for funds be due a couple days before that. Minimum investment's $25,000. Investment period 5 to 7 years. There's an 8% preferred return on all the money, and we expect quarterly distributions. We prepare a ton of documents. There's hundreds of pages of due diligence documents. All of our potential investors can go in and look.
And that's probably a reason why we fill up these subscriptions so quickly, is because we go ahead and have everything prepared from the day we launch.
Right.
And they can see all of the subscription agreements, the private placement memorandum, the phase 1 report, the environmental, the condition report. And so they can get really comfortable in a short amount of time.
Right.
Yeah, and we ask for commitments. Again, it's not like we launch a deal and it's a race to see how fast you can wire us money. It's a process. We have to make sure we're allowed to take your money. We have to ask you some basic questions. Have you ever been, anyway, there's a bunch of questions in there. But you have to be vetted. You have to be accepted, and you have to be on our investor list. We can't advertise this deal to the random podcast listeners and say, hey, get in on this deal. We can advertise us as a company. We're an investment company. You can go and sign up on our investor list. It's at thecriterionfund.com or howtoinvestincre.tv. And it says sign up. If you were on that list on the 23rd of December, you got this investment opportunity.
I had some people ask, hey, I didn't see this. Well, you weren't on the list, and we don't put people on our list. You've got to sign up.
Yeah.
And so make sure that you're getting access to this stuff, because once we send it out, it does fill up pretty quick.
It does. And, people forward emails. I was blown away at the amount of people that, hey, so-and-so forwarded me to this. Can we hop on the phone and talk? And I love those opportunities. I love this time of year because all of our investors are calling me, asking me questions about the deal. They're verifying wiring instructions. They're sending it. They're excited. They're asking me what's coming up for the year. It's an exciting time. People love these opportunities, and it shows.
Well, last thing I want to do, and it's a little bit of a plug, but one of the things that helped us fill this thing up so quickly is that we kind of had a success story. We closed our first ever development with Criterion, Kitty Academy in Denver.
Yeah, super exciting stuff there.
Why don't you just give us a 30-second on that?
Yeah, so it was a development of a pre-leased Kitty Academy in Columbine. It was an infill spot. There's not a lot of land and development opportunity in that part of Denver. It's Rocky Mountains and then Denver. So there's not a lot of excess area there.
And it's growing like crazy.
Yeah, population growth is off the charts. We partnered up with the Woodmont Company and Kitty Academy, and they've been great partners. We built the deal, had a little bit of delay up front in
some permitting issues, some weather issues in Denver.
Yeah, but got the deal built. It was perfectly fine. The deal looked great as far as the physical construction. Tenant took occupancy, and I think they had free rent for 6-12 months. And we took it out to market and sold it for 50 basis points better than what we thought we were going to sell it for.
Yeah, it took a little longer than we originally thought, but we sold it at a better price.
Yeah,
a little longer.
Yeah, and the investors on that deal got a 1.37 equity multiple, and then
and that was just in a little less than 2 years.
A little less than 2 years, and there's more coming. There's we had to escrow $100,000 at closing, so that'll come back to the investor too and boost their IRR even more. But it was a great one. We've got another one under construction right now in Dallas that's about to be finished up. We're looking at another one in New Jersey, I believe he told me. And that Kitty Academy literally said, hey, there's this building. It used to be something else. We've got a franchisee. You need to buy that building. It's like, okay.
Well, that's similar to what we did in Vegas, where we had an old restaurant, and he's like, we got a tenant that wants to go in this restaurant. You need to buy that restaurant. And so we did.
Yeah. And so we had money to him within a couple of weeks. I mean, it was, that's why we're great partners for them. It's rare you can call somebody and they wire you.
We can react pretty quickly.
Really quick.
Well, so just to recap, this is a great deal. We, once again, very random how we found it. I was just literally sifting through the hundreds of emails that I get from brokers, saw the cap rate, saw it was Wichita, it was close. I knew we could go look at it pretty easily. Started digging in, low price per foot. Okay, is it in a bad area or is there an opportunity? We established that there was an opportunity. And then you just keep pressing on the deal each and every day. And something is going to either continue you down that path or it's going to knock you off. So there's going to be a deal killer that comes up, or you're going to continue. And we didn't see any deal killers. Right. We continued, and now we're closing in a few days with an oversubscription. So anyway, I just thought it'd be interesting for people to hear kind of how we found it, how we looked at it, and how we funded it.
Yeah, and again, we're going to launch another deal here in another month, probably into February. So we'll probably launch that first week or two of February. I'm working out some of the final details right now. We're about to go down to Plano, check out the site.
So it's a great area. Get
on the list. There's going to be more opportunities. After that one, there's going to be another one in another month or two. So there's tons of opportunities to get involved. Sign up for the list. It's on our website, howtoinvestincre.tv. Sign up, and we'll see you next time. Thanks, guys.
Thanks.